This is part 3 of the Chapter 1 lecture. The first thing I want you to know, and you need to memorize this, are the account types, the categories of accounts. And you'll see here the abbreviation ALORE is a good way to help you memorize that. If you don't understand the account categories, there's no way that you can create financial statements. So it's the very first thing you must memorize. Assets are resources that you own that are going to help you make money. Liability is money that you owe creditors. Owner's equity is the owner's stake in the business, and you saw in the transactions that includes our capital account, owner's equity, and then we have a drawing account, which is a contra equity account. Revenue is money that you earn. Expenses are the cost of doing business, and the book definition here is assets used in the process of earning revenue. Also, it's important to know that some students get hung up on the word own, resources that you own. If you have a legal right to that asset, like if you have the ability to park that car in your driveway or that delivery truck in your parking lot of your company, and you have a legal right to use that, then for all practical purposes, you own that. You have a legal right to it. Even if you owe money on that, you can still count that as an asset. So I do have students ask me about that. And then remember that revenue is money that you earn. And in accounting, under GAAP, we use something called accrual-based accounting. And accrual-based accounting says that revenue is reported when it is earned, not necessarily when the money is collected. So don't get confused by that. If you have done the work, then you have earned the money in this particular class, in this project with Chris Clark, okay? So these are the account types. We're going to look at financial statements. Once we've analyzed the transaction and we've written those down, then we're going to prepare a report so people can see how we've done during a month or a year or a quarter, and those are called financial statements. And there are a couple of charts in the chapter I do want you to read over, and each one is going to tell you a little bit more about the financial statement process and also about the financial statements themselves. But here, what I want us to do is go ahead and look at the income statement. It's going to report revenues and expenses for a period of time. And I've typed this down for you here. I'm going to move it over. The formula for the income statement that you do need to memorize is revenues minus expenses equals net income. That's the formula for the income statement. You must memorize that. And the slide tells us that the matching concept is applied here because we're going to count the expenses that were incurred during the period when the revenue was earned, and we're going to match those up against each other to tell whether we have an income or a loss. So now we're going to look at an example exercise. It says the revenues and expenses of Chickadee Travel Services were as follows. Fees earned, that would be our revenue, $263,200, miscellaneous expense, office expense, and wages expense. Well, if you look back to our account categories, expenses are the cost of doing business. Another great thing about expenses is that they all have the word expense in the account. And then the revenue account in that particular example is going to be fees earned. So I'm going to go back here. So you know the formula for the income statement is revenue minus expenses equals net income. So what you'll do is you'll type in the fees earned, which is our revenue account, and that's the revenue amount here. Then you'll take expenses and you'll list out the expenses, total up the expenses, and then you'll find the difference. If the money you earned is more, then you have a net income, which you'll end up with a positive number. If you end up with a negative number here, the answer would be a net loss. Also, I want you to notice that the first thing you'll see on the income statement is the name of the company, and then you'll see the name of the statement, income statement. And for the income statement, it is created for the year ended. It could be for the quarter, or it could be for the month ended, and then the date. And that's because these fees earned were earned in that year. These expenses were incurred in that same year. And so the income statement will always comply with the matching principle. The next statement we're going to look at is the statement of owner's equity. It's going to report the changes in the owner's equity for a period of time. It's always prepared after the income statement because you have to know if you had a net income or a net loss before you can create this statement of owner's equity. And you see here I've written down the formula for the statement of owner's equity is BIND, B-I-N-D. It's beginning capital plus additional investments plus net income minus drawing is going to equal your ending capital balance. So you want to write that down and memorize that. Now we're going to look at an example exercise of the statement of owner's equity. It says using the income statement for Chickadee, which is what we just did, prepare a statement of owner's equity for the year ended April 30th, 2016. Adam Cellini, the owner, invested an additional $50,000 in the business and withdrew cash of $30,000 for personal use during the year. The capital of Adam Cellini was $80,000 on May 1st, 2015. So remember, I'm going to rewrite the formula down here for the statement of owner's equity. BIND, beginning capital balance was $80,000. So we start with that. Additional investments, that's what the I stands for, is $50,000. Net income increases capital, so you'll add that, was $55,550, and we got that from the income statement 2 slides ago. Then you say less withdrawals to figure out if you have an increase or decrease in owner's equity, and then here's your capital account. Also, when you're working a problem like this in Cengage, if there is an extra blank, it's probably for a subtotal like this. So just remember, Cengage does like subtotals. If there's a blank you're not quite sure what to do with, see if a subtotal might go there. And so then Adam Cellini ending capital balance would be $155,550. This is the statement of owner's equity. The next financial statement we're going to look at is the balance sheet, and I'm moving over the formula so you can see that. And you've seen this before. The formula for the balance sheet is the accounting equation. Assets equal liabilities plus owner's equity. It is a list of all your assets, liabilities, and owner's equity as of a specific date. It's said to be a snapshot of all your assets and liabilities and equity on a certain day of the year. The account form is what we're going to learn first, and you'll see what that's going to look like next. Using the following data for Chickadee Travel Service, as well as a statement of owner's equity, prepare a balance sheet as of April 30th, 2016. It gives us our liability, accounts payable, accounts receivable is an asset, cash, land, and supplies are all assets. So you'll list the assets first on the left side. And you'll list the assets in order of liquidity, and that means cash always goes first. It's which assets can be converted to cash the quickest. And so cash is going to be listed first, accounts receivable, supplies, and then land, and then you'll total your assets on the left side. On the right side, you'll list your liabilities and total those, and then your owner's equity. Well, the only owner's equity that goes on the balance sheet is your end of the year capital balance. So you have to complete the statement of owner's equity before you complete the balance sheet every time you create financial statements. And then total liabilities and total owner's equity should always equal total assets. So then you double underline this statement when it does equal. You'll also notice that it doesn't say for year ended. It says the balance sheet is created on a certain day, April 30th, 2016. The last statement we're going to look at is the statement of cash flows. It's going to be a summary of the cash receipts and cash payments for a specific period of time. And we're going to divide our statement into 3 different sections: operating activities, investing activities, and financing activities. So before you complete a statement of cash flows, you have to have a good understanding of what these 3 activities will cover. So it says that the cash flows from operating activities reports a summary of cash receipts and cash payments for operations. So I'm going to add to that definition down here just so that you know the operations are the normal everyday operations of the business. So those are cash flows that happen day in, day out, just because you're operating your business. The next section is investing activities. And investing has to do with long-term assets. It's the acquisition and sale of relatively permanent assets. The third section is financing. And financing is equity, which means cash brought in by the owners, and it also could mean long-term debt. And so the cash flows from financing activities reports transactions related to the owner borrowing money and withdrawals by the owner. So now we're going to look at an example exercise here. It says a summary of cash flows for Chickadee Travel Service for the year ended April 30th, 2016 is as follows. Cash received from customers, cash received from the owner, cash paid for expenses, cash paid for land, and cash paid to the owner for personal use. The cash balance on May 1st, the beginning cash balance was $72,050. So then we're going to use this information to fill out the cash flow statement. So the first thing we're going to do is put in the beginning cash balance of $72,050. And that goes here on the line next to the bottom. Cash as of May 1st, 2015, $72,050. Cash at the end of the year, we're going to figure that out in just a minute. Then we're going to find cash flows from operating activities. Well, it says that we're going to include the cash received from customers and the cash payment for expenses because those are the cash inflows and outflows of the everyday life of the business. And then we add net cash flows from operating activities because operating activities did generate a positive cash flow of $41,000. Cash flows from investing activities, you'll remember that investing has to do with long-term assets. So cash payments for the purchase of land means that we have a negative flow of cash for investing activities because we purchased land. So it's not a bad thing because we got land, but it's a negative flow of cash. So you would put a negative there, $80,000. Then cash flows from financing. You'll remember that financing has to do with equity, which is the owner, and then it has to do with debt, long-term debt. So it says cash received from owner as an investment is a positive cash flow. Cash withdrawals by the owner would be a negative. So you would net those two against each other to get net cash flows from financing activities. When you add $41,000, negative $80,000, and $20,000, you get a negative cash flow of $19,000. So you see here on this line item, it says net decrease in cash during the year. So if your beginning balance was $72,050 and your cash decreased, then your ending balance has to be $53,050. And that should be the cash on the balance sheet. Now we're going to look at Chris Clark's business, Net Solutions. This is what we worked through just a few minutes ago. And you'll see here that we're going to use the end of the month amounts to create these financial statements. The first financial statement is the income statement. So what we'll do is we'll list our revenue, $7,500, and then we'll list out each expense to find out if Chris Clark made a net income or a net loss his first time in business. And you'll see here, fees earned, $7,500. All the expenses are going to be listed from largest to smallest. Miscellaneous is always last. And then you'll total your expenses. And you have net income of $3,050. Then this arrow tells you net income will be carried to the statement of owner's equity. Chris Clark capital at the beginning of the year was $0. That's because we didn't have a business until this year. So anytime you have a new business, the beginning capital is always $0. His investment was $25,000. Net income $3,050. His withdrawals were $2,000, which makes ending capital $26,050. Then you're ready to complete the balance sheet. Total assets, you'll total up the end of the month cash, supplies, and land accounts to equal $26,450. Accounts payable is $400, and then the end of the year capital, which we got off the previous statement, is $26,050. So our total assets do equal our total liabilities plus owner's equity. And then we have the statement of cash flows. Our operating activities include cash received from customers, deduct cash payments for expenses and payments to creditors. Net cash from operating activity is $2,900. Investing includes long-term assets. Land is a long-term asset, and we paid cash to buy land of $20,000. Then for financing, remember that has to do with borrowing money, and also it has to do with equity of the owner. And so we received cash from the owner of $25,000. We paid cash to the owner of $2,000 for a net $23,000. So the net increase in cash is $5,900. And that would be our ending cash balance, which is also on the balance sheet. And then I want you to see this one exhibit in the chapter. It's always good to read through the exhibits just so that you know how the statements are related, the interrelationship between the statements.